I'm Jamie Siminoff, Chief Inventor and Founder at Rig, and you're watching Taking Stock.
Tail of the tape, look at that. 2 minutes to go into the close. The major market indexes are in positive territory in a pretty big way. A nice pressure to the upside here for the S&P 500, the Dow, the NYSE Composite Index, as well as the small caps. It does not look as if we'll finish quite at session highs, but investors digesting lots of new economic data, also getting those January FOMC minutes showing very much a divided Fed with an uncertain path moving forward with regards to short-term interest rates. Our very own here at the NYSE, Eric Criscolo, is on deck. He'll join us right after the bell for his take on the minutes, general earnings, and much more. Volatility down for the day with the VIX falling about 4.5% to 5%. Yields elevated across the board as we do see some rotation from investors back into technology shares as well as discretionary. Those two sectors, along with energy, are the strongest performing in the S&P 500 on this Wednesday. Losses to the downside led the laggards anyway, utilities, real estate, as well as staples. Welcome to the broadcast. You are watching Taking Stock. I'm your host today, JD Durkin, a few moments away from the ringing of the iconic closing bell down here on the trading floor of the New York Stock Exchange. The amazing team from Duke Energy, ticker symbol DUK, right here at the big board. They are set to do the honors. Gold and silver both inching higher, not big dramatic moves for the precious or industrial metals, and the crypto majors continuing their skid, though we like to say sideways is a direction. The Mag 7 all higher with Amazon the big winner. We'll talk a lot more about it in just a bit. Time now for the bell. You gotta hit the gavel with some authority. We always love when that happens here. The team from Duke Energy bringing about a close to the closing auction here on Wall Street. Your final tail of the tape on this Wednesday, February 18th. The S&P 500 up about 0.6%. The Dow 30 up about 0.3. The New York Stock Exchange Composite Index up at this hour about 0.4%. How about the small caps as well? The Russell 2000 getting in on the fun, up about 0.5% as well. Also live at this hour, the USA men's hockey team tied after one period against Sweden in the quarterfinals. I promise I'm very much focused on the markets. We also got Olympic hockey going on at the same time. Eric Criscolo, market strategist here at the NYSE, joins us. Thanks for being here.
Always a pleasure to be here, Jimmy.
You're rocking the green tie for all the green up on the big board. I always like to say with the opening guests, it doesn't feel like we're so close to all-time highs, but today, pretty normal rotation. Tech is leading, discretionary is leading. It's not one of these kind of wonky risk-off defensive days. What do you see in the markets today, Eric?
I think you nailed it right there. I mean, we've gone through the SaaS-apocalypse a couple of weeks ago, and then that just kind of swept into other areas of the market that weren't even, software-focused. Real estate companies that sold data, financial data companies, they all kind of came under this wrecking ball of AI is going to wipe out and destroy everything. And that's kind of slowed down a little bit. Software was still under pressure for most of last week, a little bit at the beginning of this week, a little bit of a rally in some of the software names today. Some of the other names that got hit, like Moody's, they had a nice bounce today. They were one of the names that got hit prior last week on those AI fears. So Moody's popped a little bit. So you're just kind of seeing maybe a little bit of a pause in that creative destruction narrative that's been going on, allowing some of the other names to kind of catch up, fears to calm down a little bit, analysts to really dig in and kind of figure out, is this something that's going to destroy these companies, or is it just a speed bump? Where are we exactly in that whole narrative?
Yeah, CBRE in terms of commercial real estate, one of those other companies. We'll be doing a deep dive on CBRE's bounce back, but that's a great example of a sector and a stock got throttled last week as we had these AI fears swipe their way through like sector by sector. It wasn't just like deep-seek, knee-jerk reaction. This thing has kind of had some teeth to it.
It was a wave. It was just a wave.
It was a wave, and we don't exactly know if we're through the wave yet or if we're back down to shallow waters. Only time will tell. What do you see on the broader technicals for the S&P 500? We're at 68.81.31 here for the close. We still have not yet closed above the psychological level of 7,000. We're all waiting to bust out those hats. But what do you see on the technicals?
Yeah, we've been trading 67.50 to 7,000 for a little while now. We're kind of stuck in this range. We tagged the 50-day moving average a couple of times. We just did it today or yesterday, and then we kind of bounced up right up to the 100-day moving average, vice versa. So we tagged the 100-day, bounced up to the 50-day. So we're kind of playing between these two levels. 7,000 definitely an area of resistance. You know, we haven't been able to really break above that at all. That is definitely something where investors want to see you get above that. We love round numbers. We love big round numbers. 7,000 is a perfect level. So that's something where, you know, if we can get momentum, you know, after this week, maybe the VIX expiration happened today as well. Oh. So some of the volatilities, the trading around that volatility is going to get sucked out. That could maybe free up the markets to move higher. We'll see, though.
Do we have options expiration Friday? It's the third Friday of the month, so we also expect that. Oftentimes we see some volatility, a lot of uncertainty specifically into the closing auction. Before I let you go, what are you seeing right now with regards to U.S. equities here in the United States versus global performance? There seems to be a lot more conversation and hype and enthusiasm about what's going on in other parts of the world as well.
Just like last year, international markets are beating U.S. markets, specifically the S&P 500. Wow. It happened last year. It's happening again this year. You look at a country like South Korea, just has been on an absolute tear, mainly because of the really big the storage companies, the memory companies that are all kind of based there, or most of them based there. They're just seeing an absolute tear up or a climb up in their index prices. But all European companies as well, they've been ripping. The European banks have been doing really well after just a long period of underperformance. So you're just kind of seeing this 1 to 2 year catch-up trade right now, where the European equities, Japanese equities, kind of Southeast Asia equities, they're all kind of just kind of moving up past the U.S.
Wow.
We've been up 70-80% over the past 3 years, so it's not a giant surprise that the U.S. is kind of slowing down a little bit. We'll see what happens later on in the year if it continues, but that is definitely a trend that's been happening in the first part of this year.
I like to say the trend is your friend, so we'll see if it continues. Eric Criscolo, market strategist here at the Big Board. Thanks for kicking us off as always. Good to have you.
It's been a pleasure.
My man, Skylar will take your mic. Tom, my man, you and I are going to head this way. Pardon me in advance to all the crowd I have to walk through. We will bring you some of the biggest analyst calls of the day. Excuse me, folks. We're going to come right through with the broadcast weekend. Thank you. All right, first up, Morgan Stanley reiterating Amazon, that is AMZN, is overweight, calling it an agentic winner with leverage. Amazon shares, one of the big winners in the Dow, up 2% today. Wells Fargo reiterating, NVIDIA as overweight, saying investors should buy the recent weakness ahead of NVIDIA's cannot miss earnings call next week. Deutsche Bank also reiterating NVIDIA as a hold. And finally, Palantir getting an upgrade from the analyst at Mizuho from neutral to outperform. They call, simply put, they say Palantir is a category of one. Shares of Palantir up 3% here on the day. And how about this for an analyst bump? Not doing a ton for the stock, but we'll take a look first up here at STUB, that's StubHub, down to 0.1%. But they did get an upgrade from Citigroup today from sell to neutral. The analysts there saying headwinds are now priced in for the ticket company because it has been down 40% over the last 4 weeks or so. But Citi says, hey, that's primarily due to these AI fears. Eric and I were just talking about heightened regulatory concerns as well. We will see what investors have in store for that particular stock tomorrow. And how about CBRE in terms of commercial real estate, one of the sectors that got absolutely rocked with these AI fears, having a nice bounce back session, up about 7.5%. One of the best performing names in the S&P 500 today after selling off 30% last week over 2 days. Commercial real estate, one of those hardest hit sectors. Shares of CBRE are down 5% so far here in 2026. As Eric Criscolo and I were just talking about there a few moments ago, there's a lot of renewed interest over what's going on, not necessarily here in the U.S., but around the world. And to that point, Remy Blair, the lead anchor of FinTech TV, sat down with Swen Lorenz of Sarnia Asset Management to talk about investing opportunities in the United Kingdom as well as other parts of the global economy. Take a look.
Welcome to FinTech TV. I'm Remy Blair. The U.S. stock market marked the third consecutive year of double-digit gains in 2025, but international stocks did even better with returns nearly doubling. Domestic stocks and outperforming the S&P 500 for the first time in years, and this could be the start of a multi-year cycle where international investing is not just about diversification, but also a driver of growth. Well, joining me live at the New York Stock Exchange is Sven Lorenz, CEO and founder of Sarnia Asset Management. Sven, great to have you here. Thank you so much for joining me.
Hi, good morning. It's great to be here.
Well, 2026 is well underway, and when we're talking about the markets and opportunity, I think diversification is something that keeps on coming up. So when it comes to the UK market, give us an idea of what is actually happening on the ground.
Well, you can buy into world-leading and market-leading companies right now at a price-earnings ratio of 3. And in a way, I could almost stop here now, because in the Western world, there is no other place, there's no other major country where you can buy quality assets at such low valuations. I think it's a generational investment opportunity. And UK is currently obviously undergoing some political challenges as well, to put it like that. But in terms of buying assets on the cheap, investing money and diversifying, as you rightly put it, into a different market that is running at a slightly different pace than the US, that's the big opportunity right now.
And you mentioned valuation. So why does the UK market trade at persistently low valuations? Can you walk us through this compared to the US markets?
Most people will wonder whether it's all down to Brexit. And let's just keep in mind, Brexit was 10 years ago. So this situation has obviously moved on since then. It is entirely true that the UK as a market and as an economy is somewhat trailing behind the US in terms of innovation, in terms of governance as well. And that trickles down to boards as well, boards of publicly listed companies. Capital allocation is much more old-fashioned and slow and less aggressive than in the United States. So, for example, many companies are still primarily focusing on paying dividends instead of buying back stocks. And if your stock is trading at a single-digit price-earnings ratio and you've got a yield for government bonds of 5%, it makes no sense in the world to pay out dividends. You should aggressively buy back stocks. That's changing right now. Things are, moving on in the United Kingdom, and the opportunity is still early stage. So this is what you have to make use of right now, in my view.
Yeah, and you just mentioned a key word there, and that is change. So tell us what you expect to see, not just in the short term, but also the medium and long term.
So M&A action, corporate action, is there's a lot going on in the UK, especially because of American companies and American private equity companies moving in and buying these quality assets and market-leading companies on the cheap. That's not always good for investors, but at the same time, if you get a bid for a company that you own shares in and you get overnight 50 or 70% more, who's to complain? And in terms of what else is moving on, where the opportunity lies, boards, I think, are currently starting to embrace global best practices for governance. So capital allocation, executive compensation, structured in a more effective and aggressive way. All of these subjects are advancing. I think this opportunity is only going to last for 3 or 4 or 5 years, because eventually the market will have re-rated to a point where prices are comparable to other markets. So, as I said before, I'm sounding like a broken record. This is an opportunity to look at right now.
Yeah, and of course, when we're talking about markets, it's all about performance. So I understand you've said that you strongly believe that to meaningfully outperform the market, you actually need to be right about something that others do not yet believe in. So what are you focused on?
Absolutely. So I call this non-consensus viewpoints. You don't just have to be right, you have to be right about something that the market hasn't recognized yet. In 22 and sort of like from 22 to 24, I was going on and evangelizing about UK banks. And these stocks have done phenomenally well. Back in 22, no one wanted to hear about that. I would say right now, when it comes to the UK market and non-consensus viewpoints, look at pubs, look at house builders. These are, in a way, quite basic industries, but the UK, for example, has the worst housing shortage of any major European country. The government is now pushing to change that, and these companies will benefit from it, and they're trading at ridiculously low valuations. So I think this is where, in the next couple of months and years, that's where the opportunity lies.
Well, Sven, thank you so much for joining me here at the New York Stock Exchange, and thank you so much for sharing your insights and perspective regarding the UK market, which is just across the pond.
Pleasure to be here. Thanks for your time.
Thank you.
Welcome back to the show. You're watching Taking Stock live from the trading floor of the New York Stock Exchange. Time now for the latest headlines in the worlds of fintech, crypto, and artificial intelligence for your afternoon. First up, the crypto majors are under pressure Bitcoin currently down about 2% relative to yesterday's levels. ETH down 2.7. Solana, the hardest hit of the crypto majors, down 2.8%. Next up, NVIDIA and Meta deepening a multi-year partnership that will put millions of NVIDIA's next-gen Blackwell as well as Rubin AI chips into Meta data centers to train and run Meta's next generation of AI models. And finally, Robinhood raising $1 billion for a new publicly traded fund that would allow retail investors to buy into private companies before they hit the public markets. It's a push to democratize pre-IPO deals as trading revenue slows. Our next guest of the broadcast joins us now remotely. Santiago Roel Santos is the CEO of Inversion. Santiago, it is great to have you here, joining us here on Taking Stock. First and foremost, give us an introduction for anyone who might be a bit unfamiliar to your work at Inversion, and what are some of your top priorities here in 2026?
Thanks for having me on, JD. Inversion is a private equity fund. We think that blockchain is a very powerful technology that can make businesses more efficient. We're set out to acquire businesses, partner with management teams that see the potential of the technology. Been investing in crypto for over a decade, and so the technology's come such a long way. It's regulated now. You know, tokenization and stablecoins really can affect and really drive a lot of efficiencies for most businesses. So that's really the biggest opportunity that we see now is not so much investing in Bitcoin or investing in tokens. It's really implementing this technology, which is stablecoins and tokenization, and really drive a lot of efficiencies in businesses that we're looking at.
Santiago, how is the technology that you're talking about impacted, if at all, when we see the pricing of the crypto majors fall as much as they have? In the case of Bitcoin, down almost 50% off of our highs from Monday, October 6th.
So Bitcoin is a commodity. I would separate it from the rest of the crypto market. Where you're talking about a stable coin, that is a piece of technology that is disconnected from Bitcoin. You know, companies don't make a decision whether they want to use AWS or OpenAI or Claude based on the price of these companies. And that's unfortunately the conversation when it comes to crypto is what is the price of these tokens, not so much what can this technology really do to a business. But even in the public markets, you see a company like Figure Technologies and what they've done in the HELOC space. They've originated $16 billion of HELOCs, one of the fastest growing HELOCs, the largest non-bank HELOC in America. And their origination cost is not, is $700 relative to $11,000 for a traditional HELOC company. And so they've done all of that with blockchain, with stable coins, and that really is an example of what blockchain can do to a business and financial workflows writ large. And so that's really what we see from the front lines is the vast opportunity to take inefficient workflows, and what I call money for the first time ever is going to move just in time. So if you're a business moving money cross border or settling with a counterparty, it's T+3, T+20. You're paying 2 to 3 to 4% on processing costs. So the analogy is in the 1980s, you have just-in-time manufacturing. Now you have just-in-time money, and it's going to be deeply impactful for many, many businesses.
Santiago, we're up against a hard break. Please come back and join us here on Taking Stock anytime. Santiago Roel Santos, CEO of Inversion. Thank you. Folks, stick around. Much more Taking Stock coming up after this quick break. Welcome back to the show. You're watching Taking Stock. Time now for the latest headlines in the worlds of startups, raises, and rounds for your afternoon. First up, Saudi Arabia's Humane pouring $3 billion into Elon Musk's XAI, all a part of a $20 billion funding round. The move deepens the kingdom's push into AI and strengthens Elon Musk's ties to Gulf sovereign wealth. Next up, former SpaceX engineers at Mesh Optical Technologies raising $50 million from Thrive Capital to build high-speed optical transceivers for AI data centers, aiming to power the next generation of million GPU clusters. And finally, at this hour, Blackstone taking a majority stake in India's NASA with up to $1.2 billion in both equity as well as debt. It's a bet on domestic GPU infrastructure as India looks to scale from tens of thousands to millions of AI chips. Our third and final guest of the broadcast here this afternoon at the New York Stock Exchange joins us now. This is Harry Sedaris, President and CEO of Duke Energy. Just got off the podium ringing the closing bell. Congratulations. Thanks for being here.
Thanks. Great to be here on the iconic floor of the New York Stock Exchange, and so proud of a dream come true to ring the bell. I never thought I'd do something like that.
So that's where I wanted to start. What was the experience like for you, team, to actually been up here? This is one of the most broadcast moments around the entire world every day.
Yeah, it was amazing. It's something I dreamed about every time I watch CNBC and see the people ringing the bell. I wanted to do that, and it really allows us to celebrate 100 years of paying a cash dividend to our investors, which is really important. And you think about the 100 years that have gone by, we've had a Great Depression, World War II, a Great Recession, COVID, and we still paid a dividend because we know how important it is to our investors, both big investors and small investors. And as we look to the future, we're going to continue to provide that value for our shareholders.
That's incredible. We talk so much about value plays for investors, dividend paying stocks in particular. You're doing 100. Is that why your firm is down here to celebrate that 100-year mark? That's
exactly.
Incredible.
100 years, and it happens to also coincide with our 65th year on the exchange as well. So double celebration.
Talk to me about your $103 billion capital plan and some of the other things that you and your team are prioritizing here in early 2026 you would most want investors and viewers of the show to know more about.
Yeah, that's a great question. We have $103 billion that we're going to be investing over the next 5 years as we're seeing tremendous growth in our service territories. We have population migration to the Carolinas and Florida. We have onshoring, and then we have data centers that are taking our load from 0.5% growth up to 5% growth. That's 10 times the growth that we've experienced. So we're being very disciplined in how we efficiently and effectively manage that $103 billion so that we make sure that we follow what we've always done, which is making sure our customers get the value, the reliability at the lowest cost possible, and that our investors get their value as well.
How do you still ensure to the point of value for your investors and your customers? You're still keeping things affordable. I mean, let's not pull punches here. We're still dealing with a macroeconomic backdrop with plenty of questions, lots of uncertainty, and a broader financial market that is prone to its fair share of volatility.
Yeah, affordability is top of mind for everyone across the country with housing costs, healthcare costs, insurance costs, food costs. So we're doing just like we have for over 100 years, really working hard to keep costs low. Our costs are lower than the national average. They're increasing lower than the rate of inflation, and that's important to our customers as we build for the future. And these data centers that I mentioned that are driving the load, our contracts are structured to where they're paying their fair share. So they're not spreading their costs over to the broader base of the customers. And in fact, over time, those large loads are actually going to reduce costs to our customers as they take on more of the fixed costs.
Yeah, we continue to work our way through fourth quarter, holiday quarter earnings for a lot of the big companies here at the New York Stock Exchange. I got about 30 seconds left. What were some of your personal highlights for the firm in 2025?
We had a banner year in 2025. We hit all our financial metrics, exceeding our expectations. We did 2 transformational transactions that really strengthen our balance sheet, setting us up for this record growth that we have ahead of us. We signed up almost 5 gigawatts of new data centers in the Carolinas that bring lots of jobs and lots of revenue to those communities. And we're building 14 gigawatts of new generation to power all this as we move forward.
Harry Sedaris, President and CEO of Duke Energy, fresh off the podium, ringing the closing bell here at the big board. Thanks, and come back on the show anytime.
Thank you.
Don't go anywhere. Much more Taking Stock coming up right after this.
Welcome back. I'm Scarlett Sieber from Money 2020, and on this week's edition of Jargon Translator, we're going to be tackling a pair of acronyms that sound like they could be cousins, but are actually financial frenemies. APY versus APR. Most of you have heard these terms before, but let's just break them down because I still get questions on this a lot. Let's set the scene. You're opening a savings account and the bank's like, earn 5% APY. Then you're applying for a credit card and it's like only 22.9999% APR. And you're sitting there like, wait, are these the same thing? Is one of them lying? Is this a trap? Why are the numbers so high and why are there so many different numbers? Let's break it down. APR, annual percentage rate. This is what you pay when you borrow money. Think credit cards, loans, mortgages. It's the sticker price of your debt. But here's the catch on APRs. They do not include compounding interest. So if you carry a balance, you're actually paying more than the APR suggests. It's like when a menu says $15 burger, but doesn't mention the $5 fries and the $4 tip. APR is the base rate, not the full story. APY, on the other hand, the annual percentage yield, this is what you earn when you save or invest. Think high yield saving accounts or CDs. And unlike APR, APY does include compounding. So if your money is making money and that money is also making money, that's APY doing its thing. It's like interest with a hustle mindset. Or like your savings account is on that girl math energy where you turn $5 into $5.12 and you call that passive income. Here's the kicker. Banks love to show you APR when you're borrowing because it makes it look cheaper than it actually is. And they love to show you APY when you're saving because it makes it look juicier. It's really all about the optics here, baby. So next time you see a shiny percentage, ask yourself, is this what I'm earning? Is this the full story? Or is it what I'm paying? Is this compounding or not? Because in finance, the devil's not in the details. It's in the decimals. Until next time, that's your jargon translated. Back over to you.
Tomorrow morning here on Wall Street, we'll get the latest numbers with regards to initial and continuing jobless claims. Also a fair share of Fed speakers in the afternoon. We'll hear from Governors Bowman as well as Neil Kashkari out of Minneapolis. Lots of earnings on tap tomorrow morning. We'll hear from the ultimate big box retailer, the name from Walmart, set to report quarterly results. We'll also hear results from John Deere, Wayfair, and this time tomorrow after the close, Open Door, as well as Newmont Mining. Thank you for watching today's edition of Taking Stock. Have a great Wednesday night. We'll see you again tomorrow.